In today's episode of the Investing Mastermind podcast, Signe and Michelle discuss the second part of their reactions to Berkshire Hathaway's 2023 annual letter to shareholders, authored by none other than its legendary CEO, Warren Buffett. And I'm Michelle Markey.
And I'm Signe Lundholt.
So today in our second part, we're going to resume where we left off around the section of what we do in the shareholder letter. And the first part I would like to reflect on is what Berkshire says is their goal. They want to either own all or a portion of businesses that enjoy good economics that are fundamental and enduring. And within capitalism, some businesses will flourish for a very long time while others will prove to be sinkholes. It's harder than you would think to predict which will be the winners and losers, and those who tell you they know the answer are usually either self-delusional or snake oil salesmen. And I think that's incredible how they keep it really simple at what Berkshire's goal is. What do you think about that, Signe?
Yeah, I think it's really interesting also because, sometimes I think what he means here is that the people that are trying to predict the future are either self-delusional or snake oil salesmen, because Warren Buffett himself, what he says is that he looks for businesses with a strong competitive advantage, what he calls a moat. So of course, to some extent, he's looking into winning businesses. He calls them either healthy or sickly businesses, right? And so in that way, he's also trying to pick some companies that have a strong competitive advantage, companies that will win over their competitors. But I don't think so. When he writes about the winners and losers, I do believe what he says there is the people that are just trying to predict, like it's, the lottery or it's a casino, trying to predict that next time black is going to win, that's what he's looking at. Because of course we are trying to find some healthy businesses that are, great at competing, and in that sense want to be a winning business, so to speak. But of course we can never predict if they're also going to be that in the future. So I think that paragraph there is really great because, some of the things he said in the past about not trying to predict the future really resonates with me. What he said in the past is that, people that are there are so many experts that are trying to predict the future, and at some point someone is going to be right. At some point, when there's so many experts with so many opinions, of course, there are people that are going to be right, but that doesn't mean that you can predict the future.
A way that you don't have to worry about those things is if you can measure a company more objectively, as he continues in saying in the second paragraph here. At Berkshire, we particularly favor the rare enterprise that can deploy additional capital at high returns in the future. Owning only one of these companies and simply sitting tight can deliver wealth almost beyond measure. Even heirs to such a holding can, sometimes live a lifetime of leisure. And he wrote, with like a capital, he wrote, with an exclamation point of, he just, it's like amazing how if you just sit on a company that you're not trying to predict, like what you were just saying, that a lot of people in the media might, but you have objectively measured their financial performance and done your homework in valuing a company appropriately. If you can identify that this company is talented at deploying that capital, so allocating capital in a way that generates good returns in the future, that is what you're looking more for.
I love this paragraph here because it's like, oh, okay, that's all we need to do. Well, isn't that easy? No, it is not. It's not easy trying to, find those companies that can deploy additional capital at high returns in the future. If it was easy, then, we would all be very wealthy by now, but it is difficult to actually find those companies. And that's why, Buffett, that's what he's always been trying to do, is to find those businesses that, in case, we go into a recession, or we see high inflation or anything like that, that there is a business that can deploy capital when times are tough. And he actually mentioned it later that in 2008, during the financial crisis where banks were suffering, that Berkshire Hathaway had so much cash that they didn't need to borrow money from any bank because they had so much cash. And we're going to come back to that later, but that's also what he's saying here is be focused on all your expenses so that when times are tough that you can deploy that capital. And I know that of course some industries and sectors are cash intensive and where it's difficult to keep expenses low, but as long as the company can deploy additional capital at high returns, then we're good. But yeah, finding those patterns in businesses and trying to find some of those businesses, it's actually quite difficult, but yeah, that is what we're trying to do. So what he also writes here is that we hope that these favorite businesses are run by able and trustworthy managers. But it's actually the first time that I hear him say that not all people can actually be trusted, and that sometimes it's difficult to judge, and it has led to its fair share of disappointments. I think usually, also at the annual meeting, Buffett are good to mention people that are doing really well, some of the Berkshire managers that are doing really well. But here he's actually mentioning, well, there are some untrustworthy people out there, and he's quoting the first comptroller of the United States, Hugh McCulloch, from 1863. So it's an old one, this one, but never deal with a rascal under the expectation that you can prevent him from cheating you. And something has definitely happened here since Buffett is talking about it, and we don't know what it is. There's been some speculation that he's, thinking about Pilot, which is one of the big acquisitions that Berkshire did recently. And there was some issues with the family that owned the business and some court cases and things like that. So there's been some online speculation that maybe he's trying to, between the lines, give a hint to something there. But we really don't know what exactly he is hinting at here, except that he's saying that it can be incredibly difficult to find trustworthy managers. And another thing he has said many years ago is we want management with integrity, talent, and energy, and that the integrity part is pivotal because you don't want management with a lot of energy and intelligence because that can really go wrong. What did you think about this section here where he described management?
I think everything you said rings true to me, and I find that fascinating that there could be a potential link to some of the acquisitions they've had. So that's news to me. And he seemed a little bit salty in saying that people are not that easy to read. Sincerity and empathy can easily be faked. So it's amazing how a lot of Berkshire has built its success on forming this trust with people. Like he could just have a handshake deal with Mrs. Rose Blumpkin about her Nebraska Furniture Mart business, and it worked out really great. But I guess not all handshake deals can necessarily work out. Like even though Buffett is famous for not having to get so much proof about the financial performances of businesses, like he just kind of trusts the manager after talking with the person. It seems like maybe he's been burned lately, and that's something that he's reflecting on, of maybe why he brought up this rascal quote. So I think that's definitely a cautionary tale. Is even Buffett can be hoodwinked, as much as he is a really good judge of character. And he's not always going to get 100% right, because human beings are not 100% predictable, right? So it's good that we learned this lesson from him. But also, I think by and large, Buffett might be a little bit hard on himself sometimes. I think that he has figured it out overall, that he said, Berkshire, even though there's only a handful of companies that Berkshire has been able to invest in to move the needle, while there may now be fewer and fewer meaningful options for capital deployment at Berkshire, they've done pretty well overall. So, we keep in mind these lessons of, some cautionary tales, but at the same time have the faith that Berkshire has tried to make as good of decisions as it possibly could, and they've done really well considering.
Yeah, absolutely. What he mentions in the letter is that Berkshire now has by far the largest net worth recorded by any American business. So Berkshire Hathaway is a huge business. What he writes here is that Berkshire occupies nearly 6% of the S&P 500. It's humongous. And he says doubling our huge base is simply not possible within, say, a 5-year period. So it's something that we as shareholders, what he says here is you can't expect us to double within the next 5 years because we are huge. But what he does say is that sometimes the stock market as a whole crash, and it's possible to actually find something amazing. But right now, we as shareholders, we can't expect, a doubling of our investment if we invest in Berkshire Hathaway, unless there's some opportunity also. I also think that it's interesting, what you also mentioned is that right now there's really not any business that he says that, that could move the needle, as you also said, and there's only a handful of businesses in the United States, but none outside. What I thought about that was it's really interesting that he's writing that. Of course, I know that he's a patriot and he always have been in favor of the United States, but he really says that we should be able to trust that this growth locomotive called the United States, that it's also going to be continuing growing in the future. It really sends a strong signal that the US is still a strong economy to invest in, because what he essentially is saying, I can't find businesses in China or India or Brazil or any of those countries that where it's been talked about that they're growth nations and things like that. So what he's saying is that United States is still going to do great in the future as well, because he just has not been able to find amazing businesses outside of the United States. And in the United States, there are only a few businesses that they would actually be interested in purchasing, that he understands, and where he actually can calculate the net worth also of the business, is some of the things that he says. So I just thought that was like super interesting. And yeah, when he doesn't want to invest abroad, it's definitely food for thought that maybe it's not going as well as the media tends to paint.
And you can see Buffett's civic duty in saying, our allegiance will always be to our country and our shareholders. And they never forget that though your money is commingled with ours, it does not belong to us. And two things came to mind when he said, your money is commingled, but it doesn't belong to Berkshire, is that people are saving their money in the form of owning Berkshire shares. And those don't belong to, say, Buffett. Like those belong to you and I, who might be shareholders. And also, I thought he was reflecting on the people who might pay their insurance premiums, like with Geico car insurance. That money is also something they're kind of holding on to make more money with. But he's acknowledged in prior letters that the premium insurance float does not belong to them either. So I think he takes his civic responsibility and shareholder fiduciary duty really seriously. And that's why he says that Berkshire should do a bit better than the average American corporation. And they will also operate with materially less risk of permanent loss of capital, is what he wrote. So I think he will say, it's a modest aspiration now that Berkshire should just do a little bit better than average, but don't expect it, like you said, to go doubling anytime soon. So we should bear in mind Berkshire will make gradual progress as it continues to contribute to the business world, but it's not like it's going to suddenly go into AI and semiconductor chips and go gangbusters like Nvidia. So we can rely on Berkshire to be like the tortoise, and other companies can be like the hare.
Yeah, that's true. So I want to mention one thing because we talked about in the beginning that he mentions that you can't predict winners. And back then I said, well, he is kind of trying to predict, or not predict winners, but he is looking into modes, etc. And the reason why I said that is because in this section here, he did write a few huge winners have emerged from a great many dozens of decisions that he has made for Berkshire Hathaway, and that has been mostly fun and always interesting to run Berkshire Hathaway. So he is talking about winners, but not in the context of gambling and casinos, but in the context of having a strong moat, a competitive advantage, and actually a few businesses that did tremendously well for Berkshire Hathaway. So yeah, I just thought I would mention that because the section about winners, we just need to remember that when he talks about that, it's from a perspective of gambling, and that we can call businesses winners that are winners between competitors, for example, with the competitive advantage.
And that's echoed also in the next section of Our Not So Secret Weapon, where he said, markets now exhibit far more casino-like behavior than they did when he was young, and the casino now resides in many homes and daily tempts the occupants.
Yeah. I love that section too. So what he says is that the stock market is massively larger than when he started back in the day in 1942 when he was 11 and bought his first stocks. And today there are so many people, they're gambling it like it's a casino. So he also tells us in that section that opportunity will come. So opportunity for us as Buffett style investors, we want to grab a healthy business at a fair price. And that oftentimes happens when the overall market loses some faith in the macro economy, or something triggers a stock market crash. And what we see there is, all the gamblers are in there and selling their stocks because they don't necessarily know what they have invested into. And that's where we actually can grab that opportunity. And he reassures us that it's going to happen again in the future. And that's where we really have opportunity to scoop up some amazing businesses.
Interestingly, a little bit before that, we should remember that markets can and will unpredictably seize up or even vanish, as they did for 4 months in 1914 or for a few days in 2001. And if you believe that American investors are now more stable than in the past, think back to September 2008. And he said that the speed of communication and the wonders of technology facilitate instant worldwide paralysis, and we have come a long way since smoke signals. Such instant panics won't happen often, but they will happen. So
Mm.
I think he's giving a bit of a warning because, like you mentioned earlier when you brought up 2008, in this letter, I think Buffett mentions 2008 at least 3 times, which makes me think he's giving us a warning about the people who treat the stock market like a casino, in that when people make foolish decisions, there will be opportunities that entities like Berkshire, with having, I think, over $168 billion of cash now, that they can seize in response to some of the craziness happening in the stock market, when maybe a lot of great quality businesses might go on sale.
Yeah, exactly. And what he writes is Berkshire's ability to immediately respond to market seizures with both huge sums and certainty of performance may offer us an occasional large scale opportunity. So, with this, he's saying we have the cash, we are ready to go in if we do get into a situation where it is possible. So he talks also in this section about Wall Street as sort of a general term, and he kind of takes a jab at Wall Street, and where he kind of says that, it's all about making money, feverish activity, that you get that stress mood of Wall Street and everything we know from all the movies where they're shouting, and it's a very stressful environment. And he also say that at, in Wall Street right now, that the foolishness that we see right now, it will be marketed and vigorously marketed, not by everyone, but always by someone. So he kind of takes a jab at Wall Street, and later in the letter, he writes about Omaha. So here he describes Wall Street at this, stressful activity, and later he describes Omaha as, how come people from Omaha, like Charlie Munger, who was born in Omaha, Warren Buffett was born in Omaha. He mentions his sister Bertie, who's also a great investor because she bought Berkshire Hathaway. He mentions that Greg Abel lived in Omaha for a while. So how come people in Omaha are such successful investors? And he's kind of later joking and making, this, oh yeah, in Omaha we have, he doesn't say that, but in Omaha we have successful investors. In Jamaica they have track and field sprinters, Kenya marathon runners, and Russia chess experts. So what is it about Omaha? And I just think that, it's funny how he, describes Wall Street at this feverish place, whereas Omaha is this, sensible, beautiful place. I'm taking it kind of out of context because Omaha comes way later in the letter. I just thought it was kind of funny how he, sometimes talks about Omaha versus Wall Street, and how it's much better to focus in on Omaha than it is on Wall Street. So
Right.
yeah, so I just think that, what he says in this is really important, and he kind of says to us also, and as investors, never risk permanent loss of capital. So he writes it's two businesses. It's one investment rule at Berkshire has not and will not change: never risk permanent loss of capital. And it's something that we as investors should remember as well, that we need that capital, and we need to move in with that capital, and really not risk our hard-earned money.
He says that thanks to the American tailwind and the power of compound interest, you will be rewarded if you make a couple of good decisions during a lifetime and avoid serious mistakes. And he echoes that again when he talks about 2008-9, that Berkshire will be in a position to extinguish the financial fire rather than be among the companies that ignited the conflagration. So he will say, unlike a lot of companies that will be in trouble when there's an economic disaster, they're going to be a beacon of strength, and they're going to not only survive, but they're going to thrive and rise above the ashes of, whatever might be left in the wake of financial destruction.
Yeah. This there's a lot of painted pictures in this annual report. He's using a lot of magnificent. He's got a magnificent vocabulary for sure. Moving on to the next section, what he dives into there is, what he says again. Berkshire's strength comes from its Niagara of diverse earnings. So what he says there is that they have many earnings streams, many streams of earnings that's coming in. And that's also very important, that when you look in a business, that just one source of earnings coming from a single source, maybe, depending on, of course, your circle of competence, but maybe you want a more diverse source of income in a business. Just like, Berkshire is a conglomerate, so they have a lot of different streams coming in, and that might be very difficult to understand. There are businesses that are easier to understand, and that still does not only rely heavily on earnings from one stream. So one of the things there is to really focus on, different kinds of streams of earnings there.
And another aspect that he also mentions, and he's gone on a rant before, is how Berkshire doesn't use EBITDA, which is common in the
Mhm.
business world. They want to give you what their earnings were after all of those things that are in the EBITDA acronym, not before. So I find it very strong of Berkshire to give you his way that he does business. And basically, they're taking the high road compared to maybe how a lot of other businesses might hide behind this metric. But Berkshire does not do that. So,
Yeah, absolutely. And he also writes that they operate with minimum requirements for cash, even if the country encounters a prolonged period of global economic weakness, fear, and near paralysis. So that's also important for us as investors to pay attention to, finding businesses that only require little cash. And one thing you could look at is, for example, the profit margins. How well are the company keeping expenses low? And I know that it really depends on the sector the business is in, but we really want to see a company that's great and don't have a whole lot of expenses, but can deploy some of that capital if necessary.
to somewhat summarize this area of how Berkshire treats its financial performance, is that they interestingly do not currently pay dividends. And it makes me wonder if he's opening the door to maybe Berkshire may be paying dividends in the future when he's no longer around. But he says their share repurchases are 100% discretionary. So they're saying they don't have to do share buybacks if it doesn't make financial sense. And any debt they might have are never material. So he's showing you how Berkshire will always be responsible financially, and they will never inflict permanent financial damage. And in effect, that allows Berkshire to be built to last no matter the financial calamity. So I think it's incredible. He's giving us the blueprint, maybe as educated by the original architect, Charlie Munger, of how to financially carry yourself as a business.
Yeah, exactly. And it's just important when we read this letter that we pay attention to what he writes, because he writes about Berkshire Hathaway, and it's something that, of course, Berkshire is a great company, but if we also want to invest in other businesses, we can actually learn from what he's writing there. So our time is up for today, and we have a third episode on this annual letter because there's so much good stuff in this letter, and we'll have the third and last episode where we'll talk about this letter, and we'll be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.